This is an analysis from Alpha Business Media. Welcome. What we're going to break down today is arguably the single greatest non-commercial risk for investors in Nepal. You see, for decades, the focus has been on rolling out the red carpet for foreign capital. But for any serious investor, the real question isn't about the welcome mat, it's about the fire escape. And this quote, well, it just cuts right to the heart of the matter. The critical conversation happening in boardrooms from Singapore to London, it's not about how to get money in. It's about the excruciating difficulty of getting that money back out. This is what we call the repatriation bottleneck, and it's a problem that quietly erodes confidence and deters the world's most dynamic investors. Okay, let's really dive into this. On paper, getting your investment out of Nepal is a statutory right. But the reality on the ground? Well, that's a whole different story. It functions less like a clear procedure and more like a bureaucratic gauntlet. The whole journey starts simply enough. You file an application. But the real challenge, the real hurdle, is the mandatory second approval from the Nepal Rastra Bank, the NRB. And here's where it gets interesting. Look at step 3. The process goes from a simple check to what's essentially a discretionary interrogation. Officials can question valuations, they can demand documents from decades ago, and there's absolutely no statutory timeline for their approval. Which brings us to step 4. Delays of 6 to 12 months are common, sometimes even longer, leaving investors in this state of perpetual limbo. This kind of permission-based system, where every single exit is treated like a favor to be granted, creates a fatal level of uncertainty. Economists actually have a name for this. It's called regulatory risk. Now, it's not the risk that the law will suddenly change. No, it's the risk that its interpretation depends entirely on the mood of the person sitting behind the desk on any given day. And for an institutional investor, that level of unpredictability is just completely unacceptable. So you have to ask, why? Why does this gauntlet even exist in the first place? To really get that, we need to look deeper into the institutional psychology of the central bank, because they are the true gatekeeper of capital in Nepal. The Nepal Rastra Bank operates with what you could call a Forex scarcity complex. From their point of view, a $50 million private equity exit isn't celebrated as a sign of a healthy investment climate. No, it's seen as a $50 million drain on the nation's fragile foreign exchange reserves. And this creates a kind of defensive crouch, where the default response to any large outflow is to delay, to question, and to minimize it. This slide illustrates the core policy that really enables this whole bottleneck. You see, Nepal has full convertibility on its current account, which is for trade. So buying a car from Japan, pretty straightforward. But, and this is the key, it maintains strict controls on the capital account, which governs financial assets. That means selling your company to a Japanese investor and taking the proceeds home is incredibly difficult. This is the fundamental mechanism that allows that bottleneck to exist. All right, so now let's talk about the consequences of this system. This exit bottleneck doesn't just frustrate investors, it actively shapes the kind of capital the country attracts. It basically filters out the very investment it needs the most. Think of the system as a great filter. It repels what we're calling rockets. That's the fast-moving, time-sensitive capital, like venture capital and private equity. These funds, they operate on a strict 5 to 7 year exit clock. A year-long delay is an absolute deal breaker. On the other hand, the system attracts rocks. That's slow, immobile capital in sectors like hydropower, or patient capital from development finance institutions, which are just far less sensitive to commercial timelines. And here's the crucial point. While that patient, rocket capital is important, it just can't be the only engine for growth. The repatriation bottleneck ensures that Nepal's most innovative, high-growth sectors, the rockets like tech startups, are literally starved of the fuel they need to achieve liftoff. They become functionally invisible to global VCs, not because they lack potential, but because there's no predictable way to exit. So, where do things go from here? Well, looking forward, this situation really presents 3 plausible scenarios. For any investor considering Nepal, it's absolutely critical to assess which of these futures is the most likely to play out. The first scenario is the inertial path, basically the status quo. Nothing really changes, and high-growth sectors continue to be underfunded. The second is a technocratic fix. This would be a procedural overhaul, maybe a strict 15-day approval timeline. That would definitely reduce risk and probably attract a new wave of smaller funds. And finally, you have the paradigm shift, a bold move like liberalizing the capital account entirely. That's the kind of move that would put Nepal on the map for major global investors. Ultimately, the entire issue really just comes down to this paradox. This deep-seated institutional fear of losing foreign currency is the very thing preventing a flood of it from ever coming in. The logic is simple, right? A clogged drain prevents the sink from ever filling up. As long as that exit door is so heavily guarded, the world's most productive capital will simply say no thanks to the invitation to enter the room. And this leaves us with a really fundamental question, not just for Nepal, but for any emerging economy out there. Is the promise of a red carpet welcome what matters most? Or is the single most powerful magnet for investment a guaranteed, frictionless, and predictable path to the exit?